All right, good day everyone, and welcome back to my YouTube channel at Illumination of NG. Kindly subscribe to my YouTube channel and also don't forget to click on the notification bell so that you can be notified whenever I drop a new video. Okay, so we're going to continue the class from where we stopped in the part 1 of the video, where we discussed the meaning of IAS 23 borrowing cost. Okay. And also we talked about the various components of borrowing cost. So today we're going to look at some examples. We're going to treat examples, and for those of you who have watched the part 1 of the video, we talked about the essence of IAS 23, which is about having to recognize the interest or the cost of borrowing or borrowing cost that we need to capitalize and that which we need to expense. Okay, so we're going to recognize a part of the borrowing cost as an expenses, and we're going to recognize a part of borrowing cost as a part of the capital. Okay, so now let us do this question. So we know that when we talk about cost of borrowing, we're talking about interest and other costs, okay, such as the ancillary, what we mean by the amortization of ancillary cost, the amortization of discounts and premiums. Okay, we're talking about exchange rate differences, we're talking about finance charges. Okay, we're also talking about when we have the issue of inflation, okay, that will affect the prices of goods and services, and which we also have a direct or indirect effect on the project. Okay, the value or cost of completion of the project. Okay, so now we have this question as a Gafa Properties PLC, which is a GED company. So when we see the word GED, okay, the word GED company means a company that relied extensively on loans. Okay, so company has the following loan arrangement as at 1st of January 2023. Okay, so the annual interest rate on this loan is 10%, as seen in the question, and we have the bank loan of 10 million naira. Okay, the loan was required for the building of his new office, and the construction did not start until 1st of March. Okay, let us please take note of this. The construction did not start until 1st of March. So let's take note of that, until the 1st of March. So, we are required to determine the borrowing cost to be capitalized and expensed, and also determine the cost of assets for inclusion in the exercise of the financial process. So let us start with the workings. Let's do the workings here. So let us first determine number 1, the principal sum. The principal sum, which is the initial fund borrowed. This is 10 million naira. 10 million naira was borrowed. Okay. So number 2, we need to determine the interest payable. Okay, the interest payable. The interest payable is 10% of 10 million naira. Okay, so let's take this. We are left to 10. 1, 2, 3, 1, 2, 3, 4, 5. So that's 1 million naira. So the interest payable is 1 million naira. Okay. So at the end of the day, we are supposed to have, that is, the amount payable from our mathematical knowledge equals to principal plus interest. Principal plus interest. That's why in accounting, your knowledge in mathematics still has a lot to play. Okay, in accounting. Okay, it has a very big role to play in when you are working or you are an accounting student. Okay, so we have the amount equals to principal, which is 1 million plus the interest rate. Sorry, 10 million. Interest rate is 1 million. Okay, which is equal to what? 11 million. Okay, so at the end of the day, we are supposed to pay back 11 million there. Okay, but in accounting, we are now saying that, okay, fine, this 11 million naira, the 1 million out of it is the borrowing cost, okay? The cost you have to bear to borrow that 10 million naira, okay? So, but they are part of the, we have part of the 1 million naira that we are supposed to capitalize, and that which will go to the what? To the expense in the income statement, okay? Which will now reduce our profit, okay? So, from the question, we're told that, number four, we're just trying to break down this question. We were told that, well, the loan was required for the building, and the construction did not start until 4th of March. Meaning that from January till February, we did not use this fund, okay? So January to February, we did not use the month, which is for 2 months. So the fund was idle. It became active from March to December, okay? Which is what? Which is 10-month period, okay? 10 months. 10 months. Okay, 10 months. It became active. So, the idle interest rate, which will be 2 over what? Over 12 multiplied by 1 million. Okay, so let's do the math. Year 1, year 6, okay, 2 year 3, 2 year, that's 500,000, 500,000, okay. So 500,000 divided by 3, so let's use the calculator. So at the end of the day, 500,000 divided by 3, we should have, let me check that. So 500,000 divided by 3. So let's see what that will give us. 500,000 divided by 3 should give us, that is 16667, okay? So that is 16667. 16666, okay, 7, okay. So that's 166,667, which is what? That is the loan that has been inactive, okay? So for us to be able to determine the active loan now, okay, so for us to determine the active loan, so that will be, so let's check that. So the active loan, that's number 5. That is from, that will be 10 all over 12 multiplied by 1 million. 1 billion. So let's see that 10 over, that will be give us the balance, okay? So that's 1 million times 10 divided by 12. That's 83333, okay? So we have 833. So we now have 83333. So when we add this up, this plus this, when we add it up, should give us the 1 million, okay? 1 million borrowing cost, okay? So we're not told that to determine the borrowing cost to be capitalized. So since the borrowing cost for January to March, 2-month period, is idle, okay, it was not used during this period, okay? So this month we're going to expense, okay? Expense. We're going to expense this, and we're going to capitalize this, okay? Because this was when it was what? It was put into use. So the fund that was borrowed was put into use for a period of 10 months, okay? So we're going to capitalize it. So how do we recognize that? Okay, we know in our format, okay? So number 1, we have been able to determine the borrowing cost to be capitalized, okay? So the borrowing cost to be capitalized now, we're going to capitalize 833,333, and we're going to expense 166,667 naira. So this is borrowing cost. Okay, so total of 1 million. That's 1 million naira. 1 million naira. Okay, so let us so how do we now capitalize it? Okay, so in our income statement, in our statement of financial position, statement of financial position. Okay, sorry for that. Let me just. So in our statement, don't mind my ruling. Okay, so you can do your own and draw your own perfectly. Okay, so you know that we have our assets, or we have our assets. Okay, under assets we have non-current assets. Okay, current assets. Okay, these are non-current assets. No. So we have office building. I think we have office building. So we have the cost. Initial cost is, that will be initial cost, the initial cost, and the borrowing cost. Okay, so the initial cost is 10 million of bond for. Okay, 10 million, and the borrowing cost is 833,333. Okay, so that will give us 10,833,333 as the cost to be capitalized. Okay, so the cost that we're going to capitalize is 10,833,000. Okay, so 10,833,000 is the cost that we're going to capitalize. Now, what are we going to expense? Now, how do we recognize that? We know that in our income statement. So in our income statement, let me try and draw that. So in our income statement, okay, under our expenses in our income statement. So in our income statement, now we also have, let's say we have our turnover. Okay, we have our less cost, okay, so we have so let me do it this way. Okay, when you have your, let's say we have our opening stock. We have our opening stock. We have add purchases. Okay, add purchases. Sorry. So what we are simply saying is that in our income statement, where we have under expenses, let me just do this under your expenses, so I don't go through that route. So under expenses, we're going to recognize that's interest. Interest is going to be 166,667. So what we're going to recognize in the income statement is what 166,667 under the expense. Okay, so before I was trying to go through a particular format, but we know that when we open your income statement, we have our profit, then you have your profit brought down, gross profit brought down, you have your expenses. So under the expenses, you're going to take away interest. Okay, the interest is going to be a charge against the profit. Okay, so the profit that the cost that we're going to expense is 166,667. That's the cost we are going to expense out of the borrowing cost. and we're going to capitalize 833,333 as our what? As our capitalized